Julia, down almost 28% on year.
Down almost 28% on year, but up by a massive 25% since mid-November. And what we have seen in Fairfax are short positions decreasing. We saw a peak of about 16.5% of stock being shorted in mid-November, and since then we've seen a decrease in short positions to about 11.7%. It is still relatively high, and no doubt that the move today, a lot of it is short covering because there are still a lot of short positions in the stock. But what we have seen is an unwinding of short positions, and when that happens in a market that's illiquid as this one in the week before Christmas, we can expect to see some violent moves, and we will probably see that with Fairfax today and the move in terms of trading.
You know, by the commodity price swing lower, we're looking at rebar at almost 130 a tonne now. It's spiked over 2%. How much of this broader share price gain is down to that story?
Well, it's all about leverage, and that operating leverage is a positive when prices go up, as we have seen with iron ore prices in the last few months. And I think there's two reasons for this move by Fortescue today. One is the high amount of leverage that this particular business has, both from an operational viewpoint as well as from a financial viewpoint. It has higher gearing than its peers. In the last few months, what we've seen is a softer demand environment as well as softer prices compared to the last few years. In the face of that, what we are seeing is unprecedented expansion by Fortescue. They're ending the year with 95 million tonnes per annum run rate. They're going to ramp up Solomon Kings in the first quarter, or the March quarter of 2013, and that will take it up to 115, and then Solomon Firetail will see it at 155 million tonnes per annum by 2013. To give you an idea, when BHP and Rio Tinto developed their assets in the Pilbara region, it took decades, and so Fortescue is doing it at a very fast pace, which is quite exciting, but also means higher risk. Now, if we have a look at the infrastructure assets, it's at the heart of any producer. It's not just about digging the dirt out of the ground, but it's about the infrastructure as well. And in the Pilbara region, this infrastructure has been a battleground for the last decade. We know that Fortescue has been fighting for BHP and Rio Tinto's infrastructure assets, or access to those assets. And just a couple of months ago, we heard that Atlas Iron and Brockman had signed an agreement with QR National to develop infrastructure assets in this region. Now, this deal with QR National means that infrastructure may be opened up, and competition for infrastructure may be opened up in the region. So in the face of this infrastructure shake-up that we will probably see in the Pilbara region, it looks like Fortescue's dipping its toe in the water, selling a minority stake in its infrastructure assets to see what kind of demand and what kind of price it can get for those assets. But it's probably a smart move, given one, the leverage in its business, and number two, the moves that we are seeing in infrastructure in the Pilbara region.
To IAG, with you announcing the sale of the UK specialist broking arm. What do you make of this latest move?
Look, this is the last of Insurance Australia Group's UK assets, so it's an exit of its UK business. Last week we heard about the sale of Equity Red Star. Today we heard about the sale and the details of its commercial broking business in the UK. And its UK investments and business have been an absolute disaster. Back in 2006, we saw Insurance Australia Group investing $1.75 billion, and since then we've seen massive destruction of shareholder value, and of course it's been a distraction for management as well. The fact that it has exited the UK business, I think, will be seen as a positive, because it will allow Insurance Australia Group to really focus in on its core business of Australia and New Zealand. If we have a look at the impact of the exit of its UK business, the UK business represents about 5.5% of gross written premium. There's a negative insurance margin also associated with that. So it's not expected to be material, but all up, just tidying up the odds and pieces, are positive for Insurance Australia Group, and really allows it to focus in on its core business, which is Australia and New Zealand.